Imagine you're looking at a stock chart for the first time. It's a mess of lines, red and green bars, and numbers that seem to flash without any meaning. It feels like trying to read a foreign language without a translator. You hear traders talk about breakouts and bounces, and you wonder how they see these things that are completely invisible to you. The truth is, a stock chart isn't just a picture of past prices, it's a story. It's a story of the battle between buyers and sellers, a story of fear and greed, and a story that, if you learn to read it, can give you a massive edge in the market. You don't need a finance degree to understand this story. You just need a guide to the basics. In this video, I'm going to be your translator. We're going to break down the language of stock charts into 3 simple, foundational parts that anyone can understand. First, we'll start with the absolute basics, understanding price and time, and how to identify the most important thing on any chart, the trend. Second, we'll introduce you to your first set of tools, volume and moving averages, which help you confirm if a trend is strong and likely to continue. And third, we'll get into the really powerful stuff, learning to read candlestick patterns and key support and resistance levels to help you spot potential reversals and entry points. By the end of this, you won't see a messy chart anymore. You'll see a clear narrative that will help you make smarter, more disciplined trading decisions. Let's start with the foundation, the chart itself. When you open up a platform like TradingView or your brokerage app, you'll see a chart dominated by what are called candlesticks. These are the little red and green rectangles with wicks on the top and bottom. Each candlestick tells you a detailed story about the battle between buyers and sellers for a specific time period, whether that's 1 minute, 1 day, or 1 week. Let's break down a single daily candlestick. The body of the candle, the thick part, shows you the opening and closing price for that day. If the candle is green, it means the closing price was higher than the opening price, the buyers won the day. If it's red, the closing price was lower than the opening price, the sellers were in control. Now, look at the wicks, or shadows, poking out of the top and bottom. The top of the upper wick shows the highest price the stock reached during that day. The bottom of the lower wick shows the lowest price of the day. So, a long green candle with small wicks tells you a very clear story. Buyers were in powerful control from the opening bell to the close, pushing the price consistently higher with very little pushback from sellers. A long red candle tells the opposite story, intense selling pressure all day. But what about a candle with a very small body and long wicks on both ends? That's called a doji, and it tells a story of indecision. The buyers and sellers fought to a standstill, with the price moving wildly in both directions but closing almost exactly where it opened. This is your first clue that a trend might be getting tired and a reversal could be coming. Now, the very first question you should ask when you look at any chart is, what is the trend? Is the overall story one of going up, going down, or moving sideways? The simplest way to identify a trend is by looking at the sequence of highs and lows. In an uptrend, the chart is making a series of higher highs and higher lows. Each peak is higher than the last, and each dip doesn't fall as far as the previous one. This is a clear sign of bullish, or optimistic, sentiment. In a downtrend, it's the opposite, lower highs and lower lows. The sellers are firmly in control. And sometimes, there's no clear trend, the stock is moving sideways in a range. Knowing which of these 3 states the market is in is the single most important piece of information you can have. Now that you can identify the basic trend, let's add some powerful tools to help you confirm that trend and gauge its strength. The first and most crucial confirming tool is volume. Volume is the number of shares traded during a given period, and it's usually displayed as a bar graph at the bottom of your chart. Think of volume as the fuel behind a price move. A price movement with high volume is like a rocket with a full tank of fuel. It's powerful and likely to continue. A price movement on low volume is like a sputtering engine. It's weak and suspect. So, in a healthy uptrend, you want to see volume increase as the price moves up, and decrease slightly during the pullbacks. This shows strong buying interest. If the price is rising but volume is drying up, that's a major warning sign called divergence. It suggests a lack of conviction, and that the trend may be about to reverse. The next tool is one you'll use every single time you look at a chart: moving averages. A moving average is a line that smooths out past price data to help you see the underlying trend more clearly. The most common ones are the 50-day and the 200-day moving averages. On your charting platform, you can add these with a simple indicator search. The 50-day moving average tracks the intermediate trend, while the 200-day tracks the long-term trend. How traders use them is simple. First, they use the slope of the moving average. If the 50-day line is angled upwards, the intermediate trend is up. If it's pointing down, the trend is down. Second, they watch the price's relationship to the moving average. In a strong uptrend, the price will often stay above its key moving averages, using them as a support level to bounce off of. When the price crosses below a key moving average like the 50-day, it can be an early warning sign that the trend is weakening. Similarly, when a shorter-term moving average, like the 50-day, crosses below a longer-term one, like the 200-day, this is known as a death cross and is considered a very bearish signal. Conversely, when the 50-day crosses above the 200-day, it's called a golden cross and is seen as a bullish confirmation. Now for the most exciting part, learning to spot the key levels and patterns that traders use to time their entries and exits. Let's talk about support and resistance. These are the most fundamental concepts in technical analysis. Support is a price level where buying interest is historically strong enough to overcome selling pressure, causing the price to stop falling and bounce back. It's like a floor. You can identify it as a previous low where the stock has bounced multiple times. Resistance is the opposite: a price level where selling pressure overcomes buying pressure, stopping a rally. It's like a ceiling. It's a previous high that the stock has had trouble breaking through. The battle between support and resistance is the core drama of the chart. When the price finally breaks above a key resistance level on high volume, it's called a breakout, and it often leads to a significant new uptrend as new buyers pile in. When the price breaks below a key support level, it's called a breakdown, and it can trigger a sharp sell-off. Pro tip: a common beginner mistake is to buy right at a resistance level or sell right at a support level. The smarter play is to wait for the breakout or breakdown to be confirmed with high volume before you make your move. Finally, let's combine candlesticks with support and resistance to spot high-probability reversal patterns. Remember the doji, the indecision candle. If you see a doji form right at a major resistance level after a long uptrend, that's a very strong signal that the buyers are exhausted and a reversal down is likely. This is called a bearish reversal pattern. On the flip side, look for a hammer candlestick. A hammer has a small body at the top of the candle and a long lower wick, at least twice the length of the body. It forms during a downtrend and tells a powerful story. The sellers pushed the price much lower during the session, but by the close, the buyers fought back aggressively, erasing most of the losses. If you see a hammer form right at a key support level, it's a classic sign that the downtrend may be ending and a bounce is imminent. Your goal is not to find one magical indicator, but to look for clusters of evidence. Is the price at a key support level? Is there a bullish hammer candlestick? Is volume high on the bounce? Is the 50-day moving average sloping up nearby? The more of these signals that line up, the stronger your trade thesis becomes. Before we finish, it is absolutely critical that I give you this disclaimer. Trading stocks is inherently risky and you can lose real money. Technical analysis is not a perfect science, it's a way to gauge probabilities, not certainties. Past performance is never a guarantee of future results. I am not a licensed financial advisor, and this video is for educational purposes only. It is not financial advice. You should only trade with capital you are prepared to lose, and you should always do your own research. The goal of learning chart reading is not to make you a millionaire overnight, but to give you a framework for managing your risk and making more informed, less emotional decisions. Your call to action is this: open up a free charting platform like TradingView, pull up a stock you know, like Apple or Microsoft, and just try to identify what we discussed. Can you spot the trend? Draw a horizontal line at a clear support or resistance level. Add the 50-day and 200-day moving averages and see where the price is in relation to them. This hands-on practice is how the knowledge becomes skill. If this guide helped you start to see the story in the charts, please hit that like button and subscribe for more trading education. Thank you for watching.